Get off the sidelines and take control of your financial future at www.tackletrading.com. Get in the game.
Welcome back to the Tackle Trading Forex Trading 101 series presented by Matt Justice, and I am the aforementioned Mr. Justice. I've been trading currencies for about 4 or 5 years now. Started trading currencies basically back when one of my mentors basically told me that if I didn't learn how to trade currencies, I wouldn't have much money left. And what he was referencing was basically getting out there, understanding the value of what true money is, and what true money is and what he was getting at was fiat currencies and understanding how the fiat currency system works and what the true value of a paper currency with no commodity backing is. And so I decided to dive right into it and understand kind of what's going on in the currency market, understand the value of different currencies, understanding different currency systems like, peg systems, dollarization systems, free floating currencies, the history of currencies, and so on and so forth. And in the first edition of the Forex Trading 101 series, we talked a lot about, why we trade currencies, what's the benefit of trading currencies, from a 24-hour market to the leverage to the ease of use to the lack of manipulation that you see in the currency market that you sometimes see in other markets. And then in part 2 of the series, we talked about the different major currencies and what made up a major currency versus a minor currency versus a exotic currency, and so on and so forth. In this edition of the Forex Trading 101 series, Chapter 3, Trading Forex, we're going to talk about how we actually trade currencies and what makes up the value of a currency. Now, regarding trading currencies, it's very similar to whenever you travel to a foreign country. For example, if we were to travel from the US over to France and we wanted to go sit down and have a nice little glass of French wine, and I had good old American dollars in my pocket, I couldn't buy that nice glass of wine sitting in a French vineyard with American dollars. I would have to exchange my money for the euro, because accepted in the local marketplace is not my currency but the euro. And if I then decide, let's hop on a plane and go over to London and sit down and watch all the London sights, and I wanted to go enjoy the nightlife of London, well, I would have to exchange my dollars for now British pound. And then let's say I want to hop on a flight and go over to Japan and enjoy Tokyo. I would have to exchange my dollars for the Japanese yen, and so on and so forth. We are trading one currency for another currency, and that's the thing that most people don't realize, is that even if they don't actively participate in the art of trading currencies, they are each and every one of us are investing in currencies, and we actually do trade currencies as well. For example, we all travel to a foreign country. We convert currencies. We all have, currencies in our bank accounts, in our checking, in our savings, in our money market accounts. We all have, currencies in our retirement accounts. We're an investor in currencies, and we have to learn how to protect the value of the currency. Number one, we have to protect the value of everything we work so hard for, and we'll talk about that in later sessions, about how to protect against the value of a fiat currency. But in terms of trading currencies, trading one currency for another, that is all we're doing here in the currency market. However, we don't have to travel to London or France, or we don't have to travel over there to Tokyo. We simply convert our currency and trade them. Now, the currency market is also what I call a delta-based market, which is a directional market. You might also refer to that as a speculative market, where you just basically invest in a currency or trade a currency and make money on the direction, either up or down. So in essence, all we're doing is taking one currency, exchanging them for another currency. Now, the currencies have two currencies in the transaction. You have the first currency, which is called the base currency. The second currency is what you're converting it for, is called the counter or quote currency. It doesn't really matter what is the base currency versus what is the counter currency or quote currency. The transaction is the exact same, and I'll get to that here in just one second. The currency quote compares the relative value of the base currency versus the quote currency. So for example, let's say we have the British pound. The British pound is the first currency listed in the transaction. The base currency is the first currency. So whether it's the British pound, or whether it's the euro, or whether it's the Australian dollar listed first, that is all the base currency, with the US dollar listed second. The US dollar is listed first against the yen, it's listed first against the franc, and it's listed first against the CAD. In essence, the base currency reflects the chart. So if the chart is going up, the base currency is going up in comparison to the counter currency, or the quote currency. And if the chart is going down, the base currency is going down in relationship to the quote currency. So it really doesn't matter. It's just the chart represents the base currency as well as our transaction. Our transaction is always done on the base currency. So we are always buying or selling the base currency. So if I buy the British pound, it would automatically take the opposite transaction with the US dollar, which means I would be selling the US dollar. And if I sold the British pound, it means I would buy the base currency, or the counter currency known as the US dollar. Now the currency quote consists of $1, 54 cents, and 83 pips. That is how you read the currency quote. Most currencies, especially the major currencies, are quoted very similar to this. However, with the Japanese yen, you will only see two like $125.54 pips. So it'd only be, 2 decibels over. Most currencies go 4 decibels over, which is 1/100th of 1%. The last decibel in the currency quote is called the pip, price interest point. That is what goes up, that is what goes down. And so if we buy it at 1.5483 and it goes to 1.5583, we had just made 100 pips. If we sold it at 1.5483 and it went to 1.5583, we would be down 100 pips, and each value of each pip is relative to what we call a tick value. But in this capacity, one British pound costs $1.54 US dollars, which means the pound is stronger than the dollar. That does not necessarily mean it is stronger right now, because that's what the trend is all about. And if the pound is going down in relationship to the dollar is stronger right now than the pound. But in terms of net value, their money goes further over here than our money goes over in the United Kingdom. Now, the pip is what drives the value of a currency. It is the 4th decibel in the currency quote. For example, if I say $1, 25 cents, 98 pips, that's how you would read that quote. The 8 in the 4th decibel, the 8 is the pip. It is what goes up and down. Now, the tick value of each pip is relative to what is your lot size. For example, in the stock market, if you bought one share of one company and it went up 1 cent, the tick value would be 1 cent. So every time you had what's called a minimum price fluctuation, which is 1 cent in a stock, you would make 1 cent per 1 cent movement. But if you increased your shares to 100 shares and it moved the minimum price fluctuation of 1 cent, you would be making $1 per minimum price fluctuation. And then if you increased it to 1,000 shares, you'd be making $10 per every 1 cent movement. And so when you're looking at this in terms of the currency quote, it's relative to how much shares you have in the stock market. It's relative to how many contracts you have in the options market, and it's relative to how much money you are putting into it in a currency market or in a currency trade, and that's what we call lot size. We have 3 standard lot sizes. You have a micro lot, a mini lot, and a standard lot. Now, most traders will trade mini lots, because the reality is you don't have to put a lot into a currency trade to control a lot in a currency. So micro lots, they range from anywhere from $1,000 to $9,000 in terms of the contract controlled. And so we would put in, say for example, we're trading the minimum status in a micro lot. We're going to put in $200, for example, or excuse me, we're going to put in $20. We're going to control $1,000. That's why it's 1,000 total capital controlled, and each pip would be 10 cents. That's a micro lot. Well, if we decided, you know what, we're going to increase our position size to $200, and that means at 50 to 1 leverage, we control $10,000, and that can range from anywhere from a contract value in mini lots of 10,000 all the way up to 99,000. That means we were controlling $10,000 each pip movement. Minimum price fluctuation is $1. So if we made 100 pips, we would make $100. And then you have what's called a standard lot. And a standard lot goes from anywhere from $100,000 in capital controlled all the way up to $1 million. And when you talk about a standard lot, if I put in $2,000 into a trade, I'm controlling $100,000 in the trade, and each pip movement is worth $10. And so the pip movement is not based on how much money we put in. It's actually based on the total capital controlled, and that's what we call the lot size. So the tick value is relative to how much capital you're putting in. You have 3 standard positions. Micro lots range from 1,000 to 9,000. Mini lots, and then again, that is contract controlled. That is capital controlled. Mini lots range from 10,000 all the way up to 99,000, and then you have standard lots, which basically control $100,000 up into about $1 million in contract value. We have to put in basically about 2%. So whatever the contract value is, close to 2% is what we personally have to put in here in the States, because we're at 50-to-1 leverage. If you're looking elsewhere outside the U.S., other nations can go as high as 200, 250, 400-to-1 in terms of contract value. So let's say we're dealing over there with traders in London. They have 100-to-1 leverage, and so when they trade a standard lot, they're controlling 100,000. We're controlling 100,000 here in the U.S. Well, at 50-to-1 leverage, I have to put up $2,000. They have to put up $1,000, but at the end of the day, each pip is still worth $10. For the London trader, they might be making 1% on every pip movement versus I make 0.5% on every pip movement. The bid-ask spread is typically, not all the time, but is typically the difference in what a trader will buy or sell a currency, and it is often considered the commission that the trader pays. Although recently you're starting to see currency brokers and Forex brokers start charging a very small commission fee, sometimes $1 or $2 depending on the broker you deal with, but most of the time that is the commission that the trader pays as well. So let's look at a case study right here very quickly. This is from a recent Forex report that I put out every Monday for Tackle Trading Pro members. Here we called for a buy right into that range. It was coming back down into the 1.50 range. We started seeing slowing momentum, and then on the upward movement in price right here, we called for a buy, and then it goes up, 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 and then the next week we called for it to close the trade. And so this is basically a trade that we made in the Forex report where we had an entry of 1.5125 that was up above the prior day's high, and so we wanted to get in only when the market confirmed it was going back up. So our entry, if we put a standard lot, we're going to control $100,000. Each pip movement is relative to $10. And so if we enter at 1.5125 and we put a stop loss at 1.5050, which was right underneath the support level, the horizontal red line you see right above the buy price, you're going to take a 75 pip risk. Well, if you take a 75 pip risk, that is $10 per 75 pips. Your net risk would be $750 on a standard lot. On a mini lot, it would be $75, just depending on how you want to approach trading and how much capital you currently trade with and what your personal risk rule is. Well, our target was at the 1.5775 range, and that was based on an old resistance level from the past. And I know you can't see it to the left of the chart. And in the currency report, we started seeing slowing momentum at our target. So we said, you know what? Let's take the trade off. We had a gain of 650 pips. Total value on the gain was 6,500. You put around $2,000, just depending on what your leverage is. Sometimes a little higher, sometimes a little lower, and sometimes it's due to what the value of the currency is you're buying or you're selling. But total value of the gain was $6,500 on a standard lot, and that's how you kind of look at it. Now, that is chapter number 3 for the Forex Trading 101 series. understanding pips and tick values and understanding, processing and how to trade. In our next segment, we are going to focus on technical analysis, the study of trends and patterns and support and resistance, and we're going to get into making trades out there from a technical perspective, slowing momentum, increasing momentum, and we'll do a few series on the art of technical analysis, and then we're going to get into the Forex Trading 101 series with the actual market cycle on a daily basis, when a bank is open, when a bank is closed, and then we're going to get into currency trades, carry trades, bank open trades, go to bed trades, news based trades, and all the other things about the currency market. And then we're going to get into the future of the currency system. What is going to replace the dollar, if anything, as the world reserve currency? And we're looking at going on taking this Forex Trading 101 series another couple months from now. And at the end of that, guys, we'll put it all together and package it for all you members over there at Tackle Trading, so that you will have a place to really kind of go and take quizzes and answer currency quizzes and make sure that you are getting proficient with the art of trading currencies. Until next time, this is Matt Justice for Chapter 3 of the Forex Trading 101 series, Understanding the Currency Transaction.